Good afternoon, everyone. Can you hear me okay? Yeah, great. Thank you very much. Thank you all for attending this webinar. Everyone's favourite subject, Brexit. Today, we're going to discuss really what's happened since that fateful day. Was it December last year? I lose track of time now. And really how it's impacted our sector in particular, and generally what the future looks like. There doesn't seem to be any doubt that trade has definitely been hit by leaving the European Union. But events over the past couple of years have made it quite difficult to know exactly what is the fault of Brexit and what actually is to do with national lockdowns and everything else that's been going on. So we want to really look at what specifically has been due to Brexit and perhaps what's been a mixture, which is probably more likely. In July, Rishi Sunak sought to provide more assurances about the financial services in a Mansion House speech, and also publicised a strategy document called A New Chapter for Financial Services. But we want to explore how much clarity that's actually brought to the situation, or how much confidence it's really brought to businesses. Is the UK still the most attractive destination for financial services? Actually, it might actually still be the case if you consider that foreign companies are still investing more in the UK projects than they are in any other EU country. Now, I'm sure that you've all specifically got your own experiences in your organisations, and we'd encourage you to share these through questions using the chat function. We would like to try and keep it just to questions for the panelists, if possible, perhaps about your specific experiences. And if there are questions for a specific panelist, then please mention which one that's for. Unions and staff associations up and down the country are going to play a really important role in resisting further contraction of the sector and the potential race to the bottom when it comes to wages and terms and conditions. At the same time, trying to keep protecting members' jobs, skills, and whilst continuing to promote inclusion and diversity in the sector. So to help us tackle these issues and bring some clarity to the whole situation, we're going to be hearing from Geoff Tily, Senior Economist at the TUC, Shaun Hicks, Chief Risk Officer from Zurich Insurance, and first of all, Pat McFadden, Labour MP for Wolverhampton South East since 2005, and Shadow Economic Secretary to the Treasury since April last year. Before we start, just to clarify, if you wish to ask a question, please use the chat function, and Kevin's going to be looking after that. Kevin Watts, Secretary, and we'll be putting those to the panelists after each speaker. There will be a break just after 1 o'clock for 5 minutes, so you can grab a drink or a comfort break or something like that. So that's all really. And without further ado, Pat, I will hand over to you.
Well, thanks very much, Nick, and good afternoon, everyone. I'm just going to mention a few probably quite obvious things that we might want to touch on in this discussion about financial services and Brexit. As Nick said, I am the Shadow Economic Secretary, which means the Labour spokesperson on financial services. So I've spent the last year and a half in a lot of discussion with the sector, either with individual firms or trade bodies, talking about a number of these issues. The first thing to stress is the huge economic importance of this sector to the UK. It's about 10% of GDP. It's a major earner of export revenues. It's a major tax contributor. It's a major employer, not just in London, but throughout the UK. And therefore, it's remarkable to me that it received so little attention during the long drawn out Brexit discussions and negotiations between the UK government and the European Union. It really didn't feature in the deal that was eventually agreed and endorsed by Parliament, and indeed as far back as the Chequers proposal, which some of you might remember from a few years ago under Theresa May's premiership, even in that agreement, it was openly acknowledged there would be trade friction in services and greater trade barriers in the future than compared to our position as members. Since then, there's been a lot of talk of the possibility of an equivalence deal, but that hasn't come to pass either. We've had a memorandum of understanding, which is really a forum for discussion rather than anything substantial. We have had a unilateral declaration on the part of the UK that it will treat EU firms as having equivalence, but it's been one-sided. It's not been reciprocated on the other side of the channel, just as in the same way we have unilaterally decided not to do the requisite checks on goods coming into the country. So instead of taking back control here, we found ourselves in the position of having to make unilateral declarations that we will continue as normal, while the European Union, on the other hand, seems to be the ones who are implementing Brexit. So what have we learned in the last few months? Well, one thing is that Brexit isn't done. It's a process. It's not an event. We've got continued consequences in a number of sectors that are unfolding month by month. For example, this issue with HGV drivers, the ongoing problems with Northern Ireland, all of these things are very much with us, even though Parliament agreed the departure deal, as it were, some time ago. So let me talk a bit about the sector's response to all this. If I had to pick one word to sum up the financial sector's response to what I've just described, it would be resignation. The sector doesn't want a big political row with the government about this because they know that the decision's been taken on the form of Brexit. They've seen the agreement. They saw this coming. They saw it coming from quite a long way. So they've not sought to have a heated discussion in public about this. But that resignation doesn't mean that firms haven't been simply responding accordingly and planning accordingly. And that takes me to the research from New Financial, which shows that about 10% of the country's banking assets have been moved abroad, that about 440 firms have moved people or assets abroad. And I think most financial services companies who need to have a presence now on the other side of the regulatory divide, if you like, within the European Union, within the single market, have already done that by now. So they've set themselves up. What does that mean in terms of the impact of the UK? Well, there's an immediate impact in terms of those assets that have moved, in terms of jobs that have moved. But the thing that's more difficult to quantify is what about the future? And this is difficult to quantify because we will never know the sum of all the decisions where a financial institution is creating a new product or putting a new team together, and they have a look at the UK and the rest of the EU, and they just decide to locate it inside the EU. And that we won't even know that we've lost out on some of those things as those decisions take place. So I think it's undoubtedly the case that we've got greater regulatory barriers, greater trade friction, and a movement of assets and some movement of people. But what about the other side of the ledger? Because despite all that, the UK is still by far the biggest financial sector in Europe. It is the only truly global financial sector in Europe, and it's very, very difficult, despite the regulatory barriers and friction that I've talked about, for another medium-sized sector to replicate the kind of cluster that we have in London in particular, but also in other parts of the UK. That's not just banking, but it's also insurance, it's law, it's consultancy, it's a whole number of other services. It's quite difficult for another city starting from a much, much smaller base to try to recreate all that. The government has responded to the decisions that they've made with what you could characterize as a search for compensatory measures. Now, some of you, depending on your age, might remember a kids' TV program in school called Crackerjack. And sometimes I refer to this as a sort of search for the crackerjack pencil for the industry. Consultation after consultation on this regulatory framework or this possible change. We've seen them from fintech to listings to the future regulatory framework to green finance. The irony of much of this is that most of it could have been done while we're still members of the EU. There is no reason why the UK couldn't be a highly successful fintech sector while still being a member of the EU. But the government has stepped up the pace on these kind of consultations since the Brexit agreement came into force. That was most clearly seen in the Chancellor's Mansion House speech a few months ago. So in terms of this search for a clear role outside the EU, there's a really important point from my party's point of view, and I think from the consumer's point of view, and it's that search for compensatory measures for leaving financial services out of the Brexit deal doesn't result in a watering down of some of the safety measures taken after the financial crisis. One thinks particularly, for example, of capital requirements on business or the level of risk that the public is exposed to. And there's a particular duty on the UK to have good regulatory practices for two reasons. One is because of the size of the sector relative to the rest of our economy. And we found although that's a great thing in many ways, we also found the risks of it during the financial crisis when the taxpayer was asked to step in to help. And the second is, in terms of the reputation of the sector itself, it's in no one's interest for London to be regarded as an easy place to launder money or a place with lax controls. And frankly, the UK financial services sector has been mentioned too often in the context of these kind of things in recent years. So we are very clear that we don't want to see any kind of race to the bottom in the name of competitiveness as the government searches for compensatory measures. Time doesn't stand still, and the trade friction with the European Union isn't going away anytime soon. So it's right that we look at the strengths of the sector that continue despite the decisions that have been made. And that's why I'm very clear that, for example, in fintech, I do want to see a highly successful UK sector. We have a great creative DNA in the UK, not only in financial services, but in creative industries and in many other fields. And I think fintech is ripe for that kind of thing. It's really important that we continue to have access to the most talented people from around the world. And of course, restricted free movement was a big part of the reason for Brexit. But it's quite important that we don't shoot ourselves in the foot here by cutting ourselves off from talented people from around the world in that sense. Secondly, the move to net zero places a great responsibility on financial services companies and on regulators to try and shape this. All of this has to be paid for. There are going to be investment opportunities in energy, which has been in the news in recent days, in transport, where there's a huge battle to move from internal combustion engines to electric propulsion, and of course in the way that we heat our homes, which is probably the area that we are the most behind in the UK. Financial services got a huge role to play in this. So to conclude, Nick, I don't really believe there is some great freedom dividend from leaving the European Union. But life goes on and the decision has been made, and it's really, really important for the future health of the UK economy that our financial services sector remains strong, remains a global centre, that we keep the value of that cluster that we have, and that we adapt to the new trading position and the new trade friction between us and the rest of the European Union. And in terms of introductory remarks, I'll leave it there.
Thank you very much, Pat. Yeah, a lot to think of there. I know we had some questions through prior to this meeting. So, Kevin, do you have anything specifically for Patrick first of all?
Sorry, just coming in there. Actually, I think Patrick, thank you. You answered a lot of them, and I think it was a great insight and overview. There was one question which was, and feel free to answer this in whatever way you wish. Does it annoy you that so much that isn't the result of Brexit is blamed on Brexit? And do you have any examples?
No, it doesn't. In fact, I think it's the other way around. I think things that are the responsibility of Brexit are being swept away under the banner of COVID. And I think the consequences of Brexit are being under-discussed in the public discourse about what's going on at the moment, for example, in shortages and so on.
Okay, thank you. And I suppose just taking on that point, because I think what you painted for me was the fact that with the financial services organisations, you say a mood of resignation, they're resigned to the situation. You're saying you don't expect there to be
Kevin, I can't hear you, Kevin. Have you gone on mute?
I haven't a clue how that happened.
Okay, start again.
Okay, so you were talking about the financial services sector, and you're saying that generally the mood is one of resigned. You know, they saw Brexit coming, they understood what was going, and we're hearing a moment from Shaun how organisations prepared for that. You also said it has quite a lot of scale. You know, this is the biggest one in Europe, but is that sort of almost working against them? That although they're large, the fact is the government don't believe that any other country, any other city could replicate what the UK is doing, and therefore they're not such a big priority.
Well, it's an interesting way of putting it. I suppose another way of putting that question is, has the global scale of the UK financial services sector made the government complacent about the consequences of Brexit? I don't know that that's the case. I simply think it's extraordinary that something that is so important to the UK in all the ways I mentioned about employment, tax revenues, investment, and so on, was so neglected in the discussion. I mean, we had very, very little public discussion about the impact of Brexit on financial services. We had far greater discussion about Brexit's impact, including from ministers themselves, on other sectors which are tiny in comparison to financial services. And I think the companies got the message. And that's why I think the resignation word to me is the right one. That is my impression. I've been doing this for 18 months. I have had umpteen discussions about Brexit with either financial services trade bodies or individual companies, and that's the word that comes to my mind to sum up the mood. Is simply a practical consequence. If I could put it in sort of vernacular, it would be, right, we're not going to have a row with you about this, but we're going to move our assets, we're going to move our teams where we need to move them, and that's it. We've got the message. We, the financial services sector, know that we're not a priority for government. That's okay. Not so much that's okay as in we're happy with that, but we understand that. That to me is very much the mood of the sector regarding Brexit.
Okay, thank you very much, Patrick. Nick, I think that's all the questions at the moment.
Okay, thank you, Patrick. I mean, just one further from me, if you wouldn't mind. It struck me when you were talking there, and as I alluded to at the start, you know, the sector in the UK is still attracting that foreign investments. But do you feel that there is that these companies are looking for deals elsewhere outside of the EU? Is that the point, that they're kind of looking further afield because of some kind of, I don't know, there's some kind of stubbornness from the UK against the EU because of some of the, I guess, discussions whilst the exit deal was being negotiated?
People will still invest in the UK because of the attractions of this cluster. As I say, it is still the global financial services sector in Europe. There's no doubt about The question, as I said, that's hard to quantify is, what will you not get in future that you would have got if you hadn't left? And that's really difficult to quantify because companies aren't going to say, we would have put this here, but we're going to put it in Dublin or Paris or wherever because of that. They'll just make the decision. The second part of what you said is important, is about the atmosphere between the UK and the EU. This is not just a financial services point, but it's one that greatly concerns me. Is it's really easy to see this mood of ill will just dragging on and kind of poisoning relations between the UK and the EU for some time. I mean, we've got this story about the deal with Australia and the submarines and so on. It's not an EU issue, but you can sort of see how, for different reasons, this ill will would continue, and it's really not in anybody's interests. And we've got to find. We haven't yet found this as a country. We've got to find a way of living alongside the EU when we're not members that doesn't just result in perpetual grievance at the way the EU is implementing the Brexit agreement. We haven't found that yet. The country hasn't found that. It might be, and this is perhaps a partisan point, it might be there are some ministers who don't want to find that because actually it's politically useful to keep the grievances going. It may also be that that's true of some people in the European Union as well, that there's a political self-interest there, but it's not in the public interest. And I think we've got to get to a much better place in this relationship, whatever my regrets are about the decision in the first place.
Great, thank you very much for that. Just before we move on, I just wanted to ask Shaun or Geoff, do you have any comments or questions for Patrick yourself? Shaun?
Not at this stage, thank you.
Geoff? I'll take that. Oh, Geoff, you're on mute.
No, nor me, but much of what he said resonates with what I think, in particular this sort of notion that there's all this stuff going on, so it becomes difficult to see what might be the consequence of Brexit and disguises it or something. But you know, we can be sure there is something going on, and we mustn't think that just because we can't see it obviously doesn't mean it isn't.
Yeah, no, absolutely. I think that was a good point. It's difficult to quantify everything here. So great. Well, thank you very much, Pat. I'm sure we'll hear from you again. But next we have Shaun, Chief Risk Officer at Zurich Insurance.
Indeed.
Yeah.
So, Nick, I will share my slides. I lack Pat's confidence in being able to speak for 15 or 20 minutes without some slides to hide behind. So I will try and share my slides if I can manage that. Let me see. Hopefully you are now seeing.
That's worked.
Fantastic. You're now seeing a slide. Brilliant. So, as you said, I'm the UK Chief Risk Officer for Zurich. I've been working for Zurich in the UK for the last 20 years and have had the lovely task of being the sponsor of our Brexit programme in the UK for a number of years now. I probably don't have the same sort of in-depth macro expertise around Brexit as a topic as our previous speaker, or indeed as I think Geoff will probably bring. I will share a perspective, I guess, from my viewpoint on the battlefield as to what I've seen over the years, what this has meant for Zurich, and where things, you know, what the outlook might be, a little bit around that. So what I'm going to cover today, if I can get my slides to move. Yes, I've gone too far now. What am I going to cover today? I'm going to talk a little bit about who are Zurich, and just to make sure that people understand the context, what's happened in Zurich since the referendum. I want to say a few words on a subject that Pat touched on around the post-Brexit regulatory regime, and where there might be some opportunity for upside, offsetting some of the other things. And then actually in the context of employment and the point that Pat raised about jobs and so on, just want to say a few things about Zurich's viewpoint on workplace sustainability and our experiences there. So if I take us on to who is Zurich, the clue's in the name. Hopefully everybody would have got that. So we're a Swiss-based insurance company based in the Swiss city of Zurich. Large multinational, multi-line insurer. We employ about 45,000 people globally. We employ about 4,500 people in the UK. Within the UK, we operate a reasonably material life business, and also we operate in the general insurance market, both retail and for commercial customers. Our perspective, I think, on some of Brexit is probably slightly different, having a Swiss parent who are themselves outside of the EU. However, when we look at how Zurich undertakes business in the UK, we headed into the Brexit referendum with a life business in the UK that was dealt with through a UK domiciled, UK regulated legal entity, but our general insurance businesses in the UK, in common with quite a lot of our competitors, were making use of the EU passporting arrangements. So at that time, our general insurance businesses in the UK were passporting in from Dublin under the freedom of services and freedom of establishment rules in the EU single market. So that's Zurich and our position heading into Brexit. What happened for us immediately after Brexit was probably not dissimilar to many other people. One thing I think that we did do well and early was a clear commitment that the Zurich Group still saw the UK as a key strategic market. Actually, for a number of the reasons that Pat mentioned around the size of the UK market and our view of its sort of its longevity. So there was a very clear commitment early to our customers in the UK and to our employees in the UK that we were going to maintain a UK presence. We were committed to continuing to sell essentially the same products to the same customers via the same channels, and that's been our commitment for our end state since the beginning of Brexit, that we want to continue to be able to serve the same customers in the same way, and try to keep as much then of the regulatory change and the legal change that we need to do invisible, but to carry on being the same people to our customers. We initiated, obviously, a Brexit programme pretty quickly after the referendum vote, and spent quite a lot of time, I think, early on navigating actually the uncertainty, because we all saw we all woke up in the morning to the referendum result, but for quite some time in financial services and for quite some time in insurance, we didn't really know what that meant to us. There was, talk of this either being a relatively small change, depending on your confidence in government reaching some sort of an agreement, or far more significant change. So that navigating of uncertainty and trying to continually reassure, and I'll come back to the reassurance point, trying to continually reassure our customers and our employees that we would be there for them, has been a consistent part of the journey that we've been on. So I move on to our challenges. Some of this, I think, is probably common, not just to every insurer, but to across other industries as well. I wouldn't underplay the level of resource, distraction and cost that this has this has been for us. I won't quote numbers because I'll probably get shot if I quote numbers, but needless to say, it has been a significant commitment over the last 5 years, and a significant commitment particularly over the last 18 months, while trying to deal with other challenges at the same time. Obviously, we've had to deal with the trials and tribulations of COVID at the same time as maintaining our work and trying to maintain our momentum on Brexit. Some of the challenges that we faced, I mean, I pull out there regulatory uncertainty and clarity, and I think that manifested itself in a number of different ways. I've lost count actually of how many cliff edge Brexit moments we went through, where it was sort of, we're talking about the fact that we could have been exiting the EU in sort of 48 hours, and then actually an agreement was made for an extension. You know, we had that 2 or 3 times. We had to be ready to switch over our processes, and then actually ready to unwind it again when extensions were given. That was challenging. We've also had the challenge of actually the different responses from different European countries. So we sell a lot of business cross-border, and again I'll come on to that one in a little bit. And what we've seen is, I think there were attempts by the European regulatory authorities, and in the insurance context that would be EIOPA, there were attempts by them to come up with consistent responses for different European countries to how they would treat business that had been written in the UK, or how they would treat UK customers. I don't think that wasn't entirely successful. I think what they did was very helpful. It wasn't entirely successful. We have seen some regulatory divergence in how we have to deal with customers. The French came up with their own French Brexit ordinance regime, which meant that we had to treat customers who were in France or who had their risks in France slightly differently to other customers. So that those sorts of things have caused friction for us. Hopefully, and I think we've dealt with the divergence that we've seen to date. Hopefully, we don't see more divergence between the different European regimes as to how they treat UK customers and UK businesses, probably, you know, for political or other reasons. And the other area of uncertainty, I think, was just around then sort of the more granular rules. I mean, people may recall, because we made the press on motor green cards, you know, and I call this one out just as an example, where, you know, as an industry, we were told in the absence of any agreements, we'd have to start issuing motor green cards for people to demonstrate if they take their car to Europe, they're still insured. We managed to make the press over whether our cards were green or whether they were grey, which I never thought when I took on Brexit I'd find myself. I was chairing meetings talking about what percentage of green do you need to have in the ink for something to qualify as green, and I never thought in my career I would find myself doing that, but that's where I found myself. But it's a good example because, you know, we as an industry spent a lot of money on motor green cards, then for an agreement to be reached with the EU authorities, so they were never needed. And I think there were a number of examples like that where we put in place things only for a late agreement to then determine that it wasn't necessary. A big challenge for us, and actually for the insurance industry as a whole, is the alignment across countries, and in particular writing of what we would refer to as cross-border risks. So particularly in commercial insurance, lots of customers want to write a single insurance policy. They want their single insurance policy to cover their risks, whether their risks are in the UK or in Germany or France. And traditionally, as an industry, we've always done that. And the same thing has happened in reverse. So, you know, someone in Germany will approach their insurer They'll cover their factories in Germany, but they'll also cover their factories and their distribution facilities in the UK as well. And coming out of the EU has made writing that sort of business very, very complicated for the industry, and has put, shall I say, a lot of grit in the wheels as an industry was still able to provide services to those commercial customers who want those things, and that's a really important part of the London market. But we're not able to do it without additional friction and additional cost. The last point I will reiterate, I know I mentioned it on the previous slide, but I will reiterate, is the amount of reassurance we've had to give people. I mentioned sort of the Brexit cliff edges that we all experienced as the negotiations went on. You know, those Brexit cliff edges caused, as you can imagine, a lot of uncertainty for our employees. They caused a lot of uncertainty for our staff. In the lead up to those Brexit cliff edges, you know, we were dealing with quite large volumes of calls from customers seeking reassurance that their policies still covered them, or asking questions about what they needed to do. And that continual reassurance has been a really important part of what we've had to do. So I'd move on to post Brexit regulation. We don't have any financial services equivalents of at a meaningful level with the EU. In terms of sort of mutual recognition, what we do have is the UK seeking to maintain, I think, a regulatory regime that will be broadly equivalent for insurance with that we've got in Europe, while at the same time, I think the Chancellor said in his Mansion House speech that, you know, he would be seeking to align to international standards. I think there's 2 points I just want to pick up on here. One is the future regulatory framework. We know that's one of the many consultations that the previous speaker referred to. There's consultation on the future regulatory framework, and I think what Brexit will mean ultimately is a lot more power and a lot more control coming back to the independent PRA and FCA. I think broadly I would be supportive of that, and I'm broadly supportive of their independence. I think the key thing we need to ensure is the right balance is struck between their independence and parliamentary scrutiny as more and more power comes into those authorities going forward. And then I think it will be very interesting to see what happens with the Solvency II regulatory regime. We know there were aspects of that regime, well, I would say much of the foundation of that regime actually was the UK's regime before Solvency II, and it got taken, it got built out to become the regulatory regime for insurers across Europe. There were aspects of that regime which I think the UK regulators never liked, but those were the inevitable compromises of agreeing something with 27 nations. There were aspects of the regime that the industry would have liked to have seen slightly different. I think, you know, there's a huge opportunity now in the review that the regulators and HMT are undertaking of Solvency II to create a regime that provides the same level of protection, and I think it's absolutely vital that we have a regime that provides the same, you know, good level of policyholder protection. It certainly doesn't suit, you know, a large international insurer like Zurich to have a race to the bottom, because that's just not in anybody's interests. But I think that there are ways that the regime can now be made more flexible and more agile. There are conversations going on around the risk margin, the matching adjustment, approval processes for matching adjustment for internal models and so on, where I think there is an opportunity here for as I say, for the authorities to have a regime which is just as strong, but which is more flexible and may give some more benefit to the industry. Pat mentioned clusters, and I think probably the biggest cluster in terms of the insurance industry is clearly the London market. I don't think at the moment, I would say, we're not seeing huge evidence of large amounts of business, large amounts of insurance business leaving the UK market. The London market it's not easy to replicate. It's made up of tens of thousands of highly skilled underwriters. You've got the trading platforms to facilitate business. You've got a legal infrastructure that's built up over hundreds of years to facilitate. So at the moment, we're not seeing any large-scale movement of business out of the London market. I'm not going to try to get a crystal ball out and say what's going to happen in the future, because normally when I predict anything, I'm completely wrong. So I don't want to create any hostages to fortune. Supply chain implications was the other thing just to touch on, and I think it's impossible at the moment to distinguish what are of the various supply chain challenges that the UK is facing. What of that is Brexit? What of that is COVID? What of that is other global macro factors? But I think this is one very clearly that we need to watch in terms of its implications on the UK. The last place I wanted to go just quickly was to talk about sustainability, particularly in the context of people talk about, and it's quite rightly, there's a lot of concern about Brexit and jobs. Within Zurich, all I can say is that we've not lost any roles in the UK as a result of Brexit. We've worked very hard to ensure that all of our EU national employees based in the UK can continue to work here if that was their choice, and equally that our UK-based employees, or UK national employees based in the EU, could continue to work in those countries, because, as you could imagine, as a large international insurer, we've always had lots of movement of people across, and so we worked very hard to make sure that those people who were already working cross-border were looked after, and I believe we've achieved, I think, a pretty good outcome there. Inevitably, Brexit will make it more difficult to address skills and also career opportunities and career development by moving people cross-border within Europe as we go forward. And I think part of the solution for that, for us, actually is an initiative that we were already working on, and we will continue to work on, and we'll redouble our efforts on, around making sure that we have a sustainable workforce for the future. We are very passionate about our aim being that we want to fill the skills gap of the future, fill the skills gaps of the future. That was harder to say than I thought. By retraining all of those who are willing and want and desire to retrain, so that as our organisation moves forward, skills gaps that Brexit may have been one of the contributors to, we fill by retraining and repurposing people. And I would just put a couple of proof points on the slide here. Our research showed that we would potentially have 270 skilled vacancies in 5 years' time if we didn't do anything. We are working very hard to give our people the skills required for the future. We've got 280 people currently working on automation and data apprenticeships, and I think that's an important part of our response to challenges that Brexit could cause to the supply of skills in the future. And that's probably the end of my slightly random ramble around Brexit. But that's sort of Brexit from our perspective and what Brexit has meant so far to Zurich.
No, that's been really good. Thank you, Shaun. And I particularly found it interesting when you were talking about reassuring your customers, because actually from our point of view as unions and staff associations here, that last point you talk about, vacancies. I think there is a need for our organisations as well to be reassuring our members about this sector. Otherwise, these people could be jumping ship themselves and causing even more vacancies in the sector and losing that talent, or the potential talent there as well. So I think that's a really interesting point.
I agree. So we one of the great strengths of the UK insurance market is we have such a depth of talent, and it's not just, I know we talk about the London market, but even the London market isn't just London. There's a very significant and vibrant market for insurance in Birmingham, but even our London market business is then supported. We've got a big claims hub in Glasgow. We've got claims activities in Belfast, in Newcastle. So I think that depth of skills across the UK, it's really vital that we maintain that.
Yeah, absolutely. Kevin, any other questions came through?
Yeah, I'm going to go to the chat. We've got two questions in, Shaun. The first one is around that additional cost. So yeah, totally agree. You shouldn't tell us actual figures. This one is coming from somebody. How has the additional cost been funded? Has this resulted in a scaling down or postponement of other work?
So I'd say yes and no to the second question. How's the cost been funded? Actually, the simple answer for us actually is that we've had a pretty supportive shareholder through this. Had we had to fund this purely out of the UK business, then it would have crowded out a lot of other really important investments, which are vital to ensuring that we stay a vibrant and successful business in the future. Our shareholder has been supportive and has helped us in the funding part of the question. The reason I say yes and no is, if I'm honest, that just the sheer workload involved in Brexit, though, has probably at a level crowded out our capacity to do other things. So it's probably not a money question, but I think inevitably, if you've got lots of good people working on Brexit, those same good people aren't working on something else.
Yeah, opportunity costs can be quite huge and unmeasurable. Yeah. Second question then, on the supply chain. Obviously Zurich, as you said, Swiss-based company. Is it possible to do any comparison in terms of the UK experience of supply chain with Switzerland or even other locations that Zurich has in Europe?
Yeah, and this comes back to the previous comments about how much do you blame on Brexit, but also how much is local versus global, and what I can tell you and it's less the Swiss perspective, but I can tell you, for example, from talking to German colleagues, they are fighting against the same challenges on global supply chain as we are in the UK. Global shipping costs are very high. It's increasingly difficult to source shipping containers, to get shipping space on ships, and that is clearly That is clearly a global problem, Kevin. But it is also undoubtedly true that there are challenges that are local to the UK. Local haulage, for example, is there is clearly a UK problem on local haulage, but that's less of a difficulty for us in terms of our business and what we're trying. You know, the supply chain challenges of our business are getting things to the UK, because we're not then talking about we're not looking to move masses of goods on a daily basis around the UK. What our challenge is making sure we can source all of the supplies that we need, particularly for the claims side of our business.
Okay, and I think this one would be really helpful for people on this webinar. So you talked about, you gave the example of cross-country or over-boundary business, and actually you don't feel that's been directly significantly impacted. Have you got any words of comfort in terms of how is trade generally that you're seeing in the insurance market? I'm not expecting you to comment on Zurich, but in the insurance market, how has trade been since Brexit? Should we be optimistic, or are we still watching and waiting and seeing?
I think we will always be watching and waiting and seeing, Kevin. So I think there's two things I would say on trading. We're not seeing a massive exodus of business, as I said earlier, from the London market. Business in the London market tends to be, there's a mix. There's UK businesses, and obviously those UK businesses and the business that they bring to the market will be subject to the long-term macroeconomic trends that I'm sure Geoff will move on to in terms of what might Brexit do to the UK economy longer term. But obviously also in the London market we get a lot of specialist risks coming to the UK market from around the world. Again, we're not seeing a drop off in activity in any material way that's causing concern, but it is still very early days, would be my only caveat on that. You know, we only left the single market effectively from an insurance perspective on the 1st of January this year, so it is still early days, Kevin. I think what we're seeing is positive. The other thing then, just generally, and again it does link back to the previous comment, of course, is that it's difficult to see what effects are Brexit and what effects are COVID and other things. You know, because we've obviously had COVID. We've had the massive economic dislocation of COVID, and it's very hard to separate the Brexit effects on what's going on in the market in terms of pricing and claims and so on. It's very hard to distinguish the Brexit effects from the COVID and the wider economic impacts of COVID. And I don't think, I think it is one of those that we'll only know when we look back with the benefit of hindsight.
Yeah, that sounds like a good place. I could have other questions, but I'll save them for later, Nick, because I think that's a really good point. Just Shaun and Pat, do have a look at the chat, because you've both got some praise there from people on the webinar who are loving what you're saying and how you're saying it. Nick, I'll pass back to you.
Thank you. Well, I was just going to ask actually, again, before we kind of quickly go for a break, Pat, Geoff, do you have any comments or questions for Shaun? So Pat, can I ask you first?
No, not from me. I'm happy to press on.
Thank you. And Geoff?
Yeah, I mean, I don't know if this is unfair, but that was a really interesting perspective from the insurance part of the finance sector. But I'm aware that the finance sector is, very broad in its range of activities, and I wondered if we'd had spokespeople from other aspects of the finance industry, whether they might have had a different view, and which areas of the finance sector might have seen the least bad and the worst impact. But I appreciate that might be a bit broad.
Yeah, I mean, I've probably only got the same perspective that other people who read the press and so on. My perception would be that you might get a different perspective if you had somebody here from a commercial banking background. But that's only my perception, I guess, from reading the press.
Sure. Well, thank you. I mean, and it maybe other people on here can give their own experiences. I guess if you have those, then feel free over the next 10 minutes or so to put some of those in the chat, and we can review those when we come back from a break. So I'll leave it there for half time. If we break for 10 minutes and come back at 10 past, and then we'll hear from Geoff. Thank you very much. Thank you, everyone. We'll just give a couple of minutes and some others join us. Interestingly, I've had someone who has had to leave, unfortunately, call me during the break, as they actually came over to work in the UK from the States, and they were very interested to tell me about the extra costs that were that they actually had to take on board after Brexit, things like visas and the NHS surcharge and things like that. So it's not just affecting EU nationals, but from further afield as well. So it's just thought that was an interesting point. Didn't get a chance to get a cup of coffee because of that conversation, but there you go. So thank you very much this morning for Shaun and Pat, and we'll continue on then with Geoff, senior economist from the TUC. So Geoff, can I hand over to you?
Thank you, Nick. Just try and share my screen.
It's come up, Geoff. Looking
great. And just try and put it into play mode, whatever it's called. Okay, so that's slideshow mode. All right. Well, thank you very much. Thank you very much for having me. I mean, I'm going to try and use my slot to look at some figures around what we're trying to get at. The extent to which Brexit is hitting the finance sector and hitting the economy. As has been said repeatedly, the broad picture is of challenge kind of heaped on challenge, and I'm using a fairly gentle word there, but we had the global financial crisis, we had austerity, we had the referendum, and now we have the pandemic. So it becomes increasingly difficult to know what's going on. This is my outline. I'm just going to start off with a couple of remarks about where we stand now in the pandemic. Then I'm going to look at the perspective of the finance sector compared with the economy, then look at some broader stuff around the UK GDP and the trading story, which has come up a few times. And then lastly, I'm going to try and compare the UK with other country groups. And I think you can see something, maybe you can see something coming through this. I mean, this, I should stress, this is all provisional work that I've done for this rather than anything formal, but hopefully it might point you in the right direction. So I'm afraid there's a few charts in this presentation, so I hope you don't get too punch drunk. This one is meant to sort of present what the pandemic looks like in the context of previous recessions. So all the multicolored lines reflect the trajectory of unemployment through various other recessions. So if you look at the yellow line, for example, that's near the top, that was the Great Depression. The grey-blue line just below that was and the very prolonged one was the Thatcher 1979 recession. And then the black ones, dotted, dashed, and then solid, reflect various views of the pandemic. So the dotted black line was the first take that people had when the pandemic came along. You knew we were going to have the worst unemployment we'd ever had, and you can see that the view has been gradually moderated. And I suspect that the latest view in the solid black line was the March budget. So I suspect that the latest one will be more mild still. I think that downplays the severity and the dangers going forward, but it gives an impression of, and you know, and we have furlough in part to thank for that, I think. But this one, I mean, one of the other challenges in the pandemic is a lot of the usual data sources have broken down a bit, so it's become increasingly difficult to even capture what's going on because of the pandemic. And we've got these new source of figures called payroll statistics, so which have now come on stream very effectively, and they give us a sort of monthly take and a fairly timely take on what's going on. So this chart shows how jobs compare with the start of the pandemic, so the change on February 2020 into whatever month. So if you follow the thickest line, that's the total jobs in the economy, and you got in November of last year the sort of peak decline of about 1 million jobs altogether. And then since November last year, the position has been gradually improving up to this point in August, which is the latest month we have, where the jobs are now back, according to payrolls, are now back where they were before the pandemic began. One of the points we stress is that this isn't the case across the economy, and the position differs by industry. Here you see it, maybe they're sort of, you might call them pandemic industries or something. So on the top side, you've got public services, in particular health, which shows jobs have increased since before the pandemic, as you might expect. Business and administrative services also have increased over the pandemic. But then you get this area of what we've called hard hit industries, which are the arts, retail, accommodation, and manufacturing. And they took longer to start recovering, and they're still some way down. Finance lives in other in this one, which is the group of the rest of the industries where they're down about 100,000 on the start of the pandemic. So you've got this sort of two-speed kind of recovery going on. And then on top of that, looking into the future, there's still 1.6 million workers on furlough, so we don't know where and how easily they're going to be brought back into the economy. So there's an element of watch this space with all of this at all levels, if you like. So just to talk about finance and the economy. This is just a simple chart. The blue line is, it goes back to the previous chart, basically, is all jobs in the economy. And you see this big falling off and then coming back to where they were, 29 million, back down to 28, back up to 29 million. In effect, the yellow line in this case is what's happened to finance and insurance, which is the relevant ONS figure for jobs, for the issues we're talking about today. Here you see a sort of the decline comes in, but you don't get any recovery back. So according to these figures, about 40,000 jobs, 40,000 jobs have been lost over the course of the pandemic, but there hasn't really been any rebound like in the rest of the economy. So that is one feature. On a longer view, this one compares jobs as the yellow line with the output as the red line. This goes right back to the start of the 70s, and I think you can sort of see three waves of increases. So you see the 70s, 80s, a big wave of job gains in the finance sector. Then over the 1990s, when we get over the recession, you get another wave of job increases up to the end of the century when we hit the dot-com bust, and then you see this smaller sort of wave of job increases just ahead of the global financial crisis, and then it collapses. And then since then, the picture is basically a flatness, give or take what we saw on the previous slide, but there have been no subsequent sort of waves of activity, but equally we haven't seen any great decline, which perhaps matches with some of the things that other speakers have said. One point that I pick up, and I guess it goes back to the sort of heterogeneity of what's going on there, of the finance sector itself. A big feature of the finance sector, and particularly on the high street, is branch closures. These are which figures by bank. So Barclays are at the top, NatWest, whatever and these are the cumulative amount of job losses since the cumulative amount of branch closures since January 2015. So these began before Brexit. I gather that, and this is all information from which I gather the peak was actually 2019. 2020 was a relatively mild year for branch closures, but then back in 2021, I gather they're starting up again. But I don't know to what extent these jobs are being reabsorbed within the industries in question, or whether people are losing work. And I'd be interested to know what others have to say on that. So when it comes to GDP and trade, these ones are the headline GDP figures. The headline is the headline GDP figure is the lighter blue line. The figure for finance and industry is the darker blue line. So what you see here, you see the very massive impact of the pandemic at the level of the whole economy, shrinking by about a quarter into the first lockdown, but then coming back relatively quickly, and then shrinking again into the second lockdown, and then coming back again. I think these figures go up to July, where we stand about 2% below the start of the pandemic. If you compare with the finance line, I guess the message from this is that from a GDP point of view, at least, the impact on finance and industry has been more moderate, it's basically been, it seems to have been more moderate throughout, but it's flatlined over the course of the pandemic. The next one just looks at the change by industry to compare the finance sector, which sits in the middle, the overall decline in GDP for the finance sector, which was actually pretty small over the pandemic, with some of the other sectors, and you see there the sectors where there are still big hits like arts and entertainment, accommodation and food and so on. So on that view, the impact on the finance sector has been relatively mild, and I guess we've got things going on there. One of the key features going on there might be what's been going on in the housing market, which will have supported the figures, but from a GVA point of view, it's not massive. More interesting, I think, is when you take a longer view. So these squiggly lines go back to 2015, and they measure the level of demand, or the GDP expenditure approach, starting from 2015. The orange box indicates when the referendum happened. Then we get to the end of 2019, and you see the way the economy sort of caved in, but different aspects of the economy did differently. So most obviously in the most recent figures, you see the blue line, which is government. So as the pandemic began, government fell, but then government has come back very strongly to support the economy. The black line is GDP, I should say. But then at the right at the bottom, you see business investment in purple, almost virtually not coming back at all. Just above the purple business investment, you see the trade figures, both in orange and in pink, or the pink dotted line. And again, the trade figures came off very heavily, but haven't rebounded as much. So that seems to be a sort of ongoing area of interest. The other point here that I would point to, since the actual referendum happened, is that at the top we had both exports and imports in orange, and in the dotted pink line, they both continued to be stronger than GDP right up through to the start of the pandemic. But on the other hand, you see in the purple line, the business investment line fell behind GDP. So there might be a sense there that confidence was retreating and companies were beginning to invest less even ahead of the pandemic. And you know, as I say, you get to the present and investment is down quite substantially relative to where it was when the referendum happened. People have mentioned trade specifically, and the trouble with the trade figures is that they are incredibly noisy. This is an effort at trying to discern what's been going on with trade. My colour code here is that blue refers to trade with the EU, yellow refers to trade with the rest of the world. It's the level of trade. The dotted lines are the import figures, and the solid lines are the export figures. So if you start from the bottom, you see the EU export line not growing very greatly up until the start of the pandemic, then falling away. The non-EU, interestingly, the non-EU export figures had this very violent increase of exports towards the end of 2019, and then they fell away. So they both end up in a similar position relative to where they were at the start of 2019, if you see what I mean. But the figures are very noisy, so I think you have to be quite cautious drawing too many conclusions from these. And then you look at the imports, and you get this similar story. Perhaps the most striking thing and the most obvious thing that you see is for the EU imports. They were relatively strong through to 2019, and have been quite noisy since then, but they remain a very long way below where they were before the pandemic began. So bits and bobs there on, and that's trading goods. I'm having trouble changing my slide here. Trading services I thought were of interest actually, because they slumped very sharply into the pandemic, and then they don't come back at all. But I think that is mainly, and don't worry about this slide too much, I think that's mainly down to services. I mean, which are the main factor behind that are transport and travel, which, as you know, the tourist industry has been hit massively hard. If you actually look at the export of financial services, they seem to be up a little bit relative to the pandemic, relative to the start of the pandemic. That's the yellow line there. So a mixed bag, but you know, most definitely a hit to exports, but most definitely a hit to trade, and a hit that seemed to be happening before the pandemic. But the most striking feature, I think, is investment. As somebody else mentioned, I think this just gives you a longer view of the trade story with finance. You have this very strong export performance, which greatly outstrips imports, and this very strong trade surplus on finance. Again, the period of acceleration was in the past, and what you've had really since the global financial crisis is a more flatlining kind of story. But finance exports are still up according to this perspective. Then lastly, these are the last slides, but I think that potentially the most interesting one, if a bit difficult to unravel. So this is another expenditure perspective on GDP. So Y is GDP, C is consumption, G is government spending, I is investment, X is exports, and M is imports. And what I've done here is set the UK performance before and after the crisis against the EU performance before and after the referendum, with the EU performance before and after the referendum, and then the OECD performance before and after the referendum. So just to start with the left-hand block, you see UK growth before the referendum of about 2% a year, and then you see UK growth slowing after the referendum by about 0.5%. and this is an annual average rate. So you see it slowing from an annual rate of 2% to an annual rate of 1.5%. Whereas for these other country groupings, so for I think these are Euro area figures rather than EU figures. So for the Euro area, what you see after the referendum vote is that GDP gets stronger. So it was 1% growth a year before the referendum. After the referendum, it increased to 2% a year, and the same happened for the OECD, except the figures were higher. It was growing about 2% a year before the UK referendum, and then it increased to approaching 3% a year. So we have this sort of weird phenomenon where since the referendum, UK growth has got weaker, whereas it seems that Eurozone growth and growth across the OECD as a whole has got a bit stronger. Whether we can relate this to the referendum, I don't know. There's a lot of noise and a lot of uncertainties in these figures, but if you try and decompose exactly where that weaker growth has come from, it's mainly come from consumer spending. So in the consumer spending, in the C columns, you see strong figures before the referendum for the UK becoming much weaker in terms of annual growth. Whereas for the EU and for the OECD economies, you see consumer demand growth getting stronger. One area that it isn't, that you might have thought might have been behind this, is in government spending. Because of course of austerity, the supposition might be that the UK intensified austerity more after the referendum, but in actual fact, across all country groupings, government spending the rate of government spending growth was increased in the period after the referendum relative to the period before. So it isn't government spending that's explaining these differences. The key point, I think, maybe comes in the third column, which is investment growth, where you see UK investment growth showing very sharply, as we saw on the earlier charts. You see UK investment growth showing very sharply, whereas EU investment growth increased very sharply after 2016, and the OECD countries as well. And then the trade story for the UK supports the UK position, but it doesn't outweigh what has been going on in consumption investment. So there just might be something there, and it might be something worth watching. And then just finally, the other area where we see something is on outcomes since the pandemic. Actually, this is just one block per country in this case, and it compares where the countries stand now relative to before the pandemic. So here the UK on Y on the GDP column, the UK is about 5% down compared to where it was before the pandemic, whereas the EU is only 2.5% down, and then the OECD countries on the GDP side are in exactly the same position where they were when they started. So again, the UK seems to have been doing worse since the pandemic than other blocks of countries, and you see that this is driven in the main again by weaker consumer demand. In actual fact, the UK's had stronger government spending over the course of the pandemic. Investment has been weak, but then in this case, since the pandemic, you get both the trade outcomes on exports and imports much weaker. So there may be something there that's I don't want to oversell it, but the implication, at least at first sight, is that we have begun to do more badly than other like countries or like groups of countries, and it might be something worth keeping an eye on. And that was basically where I was going to stop. And I apologise for all the charts, but I'm afraid that's my go-to. And apologise.
Thank you very much for that. It's yeah, I mean, interesting, and I guess trying to make sense of that is a tough one. That's why it's your job. Has Geoff left us? I think he's decided that's his lot. But hopefully he'll come back in a second. It was just a mistake. But I guess there was a question, a thought really there about Geoff was mentioning it's because of consumer demand is down there, and I wonder whether actually the uncertainty in the UK caused less spending, whereas actually in the EU they didn't have the same uncertainty. They weren't I guess preparing as much Jeff, as the UK in that sense. Hi, Jeff. You're back. Thank you. Geoff, just a thought on that, and I don't know if it's something you can comment on really, but it was just my lay, I guess, thought on that last chart especially was the consumer spend or consumer demand there. Do you think that might be anything to do with some of the uncertainty that came with Brexit and actually consumers were spending less, whereas in the EU and other countries, they just didn't have that same concern?
I just dropped out of the discussion there, but I think I caught the end of your question. And I think the answer is yes. I think that there must be some uncertainty playing on UK consumers, but the other factor was inflation. So when we went out, we know what happened to sterling. We know what happened to some UK prices, which didn't happen to EU prices over that. I mean, obviously things are different now, but over the period, the immediate aftermath of the referendum, there was a period of sterling inflation, which may have pushed down on consumer demand. But I do agree that there may be some confidence effects, but maybe the real place you see the confident effects is in the business investment data, where it seems to have taken a real hit. Although part of me is slightly sceptical about the strength of business investment over the period before the referendum, actually, given what was going on with austerity and things like that. So there may be some uncertainties around the figures, but I think the idea that investment slowed relatively significantly since the referendum seems perfectly plausible.
Thank you. Kevin, any other questions come through?
Yeah, I just wanted to say, Geoff, thank you. Fascinating data. I could spend another hour, I think, just looking at those slides. Just some great stuff in there.
Sucker for punishment.
I'm wondering when Q3 comes out as well for some of that data. For me, it felt more optimistic than what you see in the press and what you see in the news. Questions, though. I'm going to link these two together. So it's going to be around about talent, but also automation and data. So two questions here in one, so sorry about that. So HGV drivers, abattoir workers, fruit pickers in short supply. Is it likely this fight for talent will seep into financial services? We've heard what Shaun is saying Zurich are doing to prepare for that. And we've heard that perhaps Zurich or even insurance businesses are probably maybe in a better place than elsewhere within financial services. So any views on that would be really good. And then I want to take you to a question that Shaun answered in his presentation, which was around this move that the UK had from probably 2018, maybe even before, of moving to automation, moving to digitalization. And with that, you've got two outcomes. You either have less jobs, branches closing, or as Shaun was saying for Zurich, they haven't actually made any redundancies directly linked to Brexit. And what they're doing is a program of sustainability and reskilling people. Could Brexit be a sort of turbocharge for people in the financial sector turning up automation and digitalization, and could that lead to far less jobs, more unemployment? Your thoughts around all that area, please, Geoff, however you want to answer it.
I mean, I thought on the HGV, the skills and the talent, I wondered if the position is different at one level. What we've seen around distribution, agriculture, and hospitality is the really appalling paying conditions exposed, both over the course of the pandemic, but particularly now when we're seeing these bottlenecks coming into play. Maybe that's not the case so much with the finance sector, where I hope that, well, I certainly know in some areas people are very well rewarded. I don't know if that's true across the board of all jobs in the finance sector, but maybe there is a slightly different starting place there. But I mean, I guess ultimately the same factors might come into play, particularly if differentials with other countries come in the finance sector. I mean, we're obviously, you know, very focused on the issue of shortages and bottlenecks. So I mean, one thing we have been worried about, not so much on the finance sector, but on the other side, is the sort of quick fix approach that some industries seem to be taking. You know, so they're lowering entrance thresholds and things like that, one-off cash payments, which we find very worrying. I mean, it's a little hard. I still find it a little hard to see the pandemic as kind of the panacea for all the ills that we used to know, like pay in appalling conditions. But maybe in some areas it will force the businesses' hands. But I think maybe a last point on that is I think that I don't think we've seen any widespread change at this stage, and too many quick fixes. On the digitisation, I mean, I was going to make a broader point. There was a question about whether Brexit did any good, which you've spared me. But I think maybe if it did anything, it's through certain failures of the economy into sharper relief. You know, we began to see that this economy, you know, over the course of the global financial crisis, over austerity, you know, it wasn't delivering for people across a large part of the country. So if Brexit did anything, it put that into sharp relief. Obviously, the voting to leave the EU doesn't resolve this, doesn't make the slightest bit of difference to the chance of resolving it and the way the government's taking it. One imagines it's making it worse, not better. But it did put these things into sharp relief, and it has made them a political issue. And so for me, it was partly a symptom, and I kind of wondered if what's going on with digitisation is also partly a symptom of greater failures that are rooted far further back. And that, yeah, as you say, it may make things worse. I mean, at the budget, the government introduced this thing called a super deduction, I think, which was going to make, which is a big tax perk for companies to invest, which again seems to be, that's all very well to invest in machinery, but it doesn't look so good from the point of view of jobs and things like that. So they almost seem to be making a prior judgment. They almost seem to be trying to push it in that direction, no matter the desirability of the super deduction itself. But I do think that, you know, one of the troubles here around the use of technology, I'm not opposed to the use of technology, but it does seem we seem to be living in a world where technology is used in kind of stagnant economic conditions to make cost savings. You know, I think ultimately we want to see a world that is expanding, where technology is used to help increase output, and it's used to reduce the burden on workers, and ultimately that the returns on that investment will be shared. But it does seem to me that we're very far from that world at the moment. You know, going back to Brexit, that hasn't led to the solutions that hasn't led to anything that we would hope or we would think that makes better. But it fundamentally comes back to doing things a different way into the future. And you know, the building back better catchphrase is the one that people use, but that seems to me that what needs to be done to start taking these problems really seriously.
Geoff, thank you. No, nicely put.
Shaun, you're on mute.
Sorry, yes, I just wanted to come in with an observation on the skills and automation conversation there, because you know, it's one I feel quite strongly about. That I think the premise of your question, Kevin, to Geoff was about sort of, you know, automation leading to the loss of jobs. And I think if you look at sort of, you know, the great sweep of industrial history, automation has undoubtedly led to the loss of jobs, and it's also created jobs. And I think the social harm is caused, and you know, there's been, you know, some very black points in history where the social harm has been caused by a complete mismatch in the skills of the people who lose their jobs with the jobs that are being created. It's either a mismatch in skills or location and so on. And I do think, and it's why, I brought up the point on, data apprenticeships and reskilling and so on in my presentation. I do think there's an onus on all of us as we go through the automation and digitization journey to make sure that we reskill people and take people with us. And I think that's true of organizations, and I think it's true of society as a whole, because I'm when we look at the future of our workforce, we're not seeing automation and digitization leading to wholesale reductions in our workforce into the future. But what we are seeing is the roles that we employ will change quite dramatically, and the skills that we require will change quite dramatically. And I passionately think that we need to stop this being a conversation about, in inverted commas, losing jobs, and start it being a conversation about how do we make sure people have the skills. And through a 40 or 50-year career, increasingly people are going to have to reskill themselves multiple times, and it's incumbent on all of us to actually take people with us through that journey. And I just wanted to say that, it's something I feel quite passionate about. And Geoff, the question I was going to ask you, I mean, you had some slides on numbers of jobs as we've gone through the pandemic, and showing the number of jobs coming back in some industries and not in others. I've not seen any commentary recently on whether COVID's had any impact on quality of jobs. And I just wondered whether you've seen anything, or if there's a view on that, or whether it's too early.
I don't know if in general, whether there has been a shift in the change of quality of work. I think one of the things that we've been concerned about is that we've seen this at various levels throughout the pandemic, is that the people who have the least have been hit the hardest, basically, and so that's both in terms of the impact of the pandemic, but certainly in terms of work, it's quite often the people who have been paid the least who've had to have had to go to work when others have been able to work from home. But it's also the industries where people are paid the least that they're still the most workers on furlough. Where the payrolls have been hit hardest, they're across a group of industries. I think those are the 5 industries that have been hit hardest. 4 of those 5 are at the bottom of the pay distribution, kind of thing. So there's certainly been. It's not necessarily the quality of work that's been impacted, but it's hitting a certain type of work at this stage. And looking forward, they are the areas where there are the greatest uncertainties about work coming back, I think. I mean, obviously there are exceptions like the airline industry, which have their own issues, but I think in general, they're the industries that still seem most vulnerable, where there are most uncertainties about going forward. That's not quite your question, but it's what I can offer.
No, thank you. That's very helpful.
Nick, I'm afraid I've got to duck out now. I've got another call starting shortly, and I've got to log on to it a few minutes early. So thanks for inviting me today, and I hope people have got something out of it. But I have to leave the call now. Thanks.
Nick, you're on mute.
Sorry, yeah, thank you, Pat. That was really appreciate you attending. So thank you very much for doing that.
Okay, bye everybody. Thank you. Bye.
Nick, can I just go back to Shaun, because I think Shaun's point was really important in terms of challenging the question. And Shaun, the thing I would add as well is it's not only about taking people with us. Those people have got to engage with the learning. They've got to engage with staying up to date with technology. And one thing that came out of Brexit was me observing more and more people getting used to technology, which maybe it would have taken them a year or two to get used to, within days, weeks, or months. And I think, you know, that was important as well.
Yeah, absolutely, completely agree, Kevin. I think, yeah, Geoff mentioned that, you know, some of us are in industries where, you know, it was easier for us all to up sticks and work from home. But the transformation that we saw within Zurich of, you know, 4,500 people, well, actually not 4.5, because some people carried on the road and so on, and that was, you know, hugely important, but probably 3,500 office-based people migrating to working from home in what, with hindsight, was a relatively seamless way. I mean, if you'd said to me a week before we had to do it that this is what we're going to do, Shaun, I'd have had the screaming heebie-jeebies probably. But actually, the way people embraced the technology, I think, was an eye-opener for all of us, Kevin.
Yeah, and I suppose the counterpoint to that, I think it fits with what Geoff's saying and your point about, have we still got stuff to see? And I think we have, because within the Alliance for Finance, Nick, and by all means pick up on this point, and I see there's exec members as well on, but there's been a lot of debate about how Brexit, COVID, the current economic situation, on what employers within the financial services are doing. And a number of the employee bodies and a number of the trade unions are very engaged in consultation at the moment with their employers, and have been over the last 6 months, and they are around changes which could very much change the number of jobs within the market or alter the work. And as somebody said, are the new jobs of the same equality or value as the earlier jobs? And I think good employers work to do that, but it's always about there's a mix, isn't there, across the whole spectrum, and that's probably all I'll say on that.
Thank you, Kevin. I mean, I think, you know, everyone here has a duty as well to make sure that people are going through that learning journey with, you know, that their employers that they're negotiating with their employers to make sure that that learning is happening. Too often, obviously, when companies are needing to kind of cut costs, that learning is one of the first things to go, and ultimately it's important in a changing workforce. And I think, you know, to pick up on the pandemic thing, that the speed at which employees did change and the companies changed, etc., to be able to carry on, you know, shows how flexible the labour market is. And, you know, the Brexit is going to change things. It has changed things. It will continue to, and I wonder how long that time lag is before actually we see a clearer picture. But you know, you might, I guess, take some comfort from the fact that we managed to react to a global pandemic in a way and carry on. So so why not the Brexit situation as well? Listen, just some final remarks, and a huge thank you to Pat, obviously, Geoff and Shaun for your input there. It was really interesting. It's really clear to me that there's still some unanswered issues, unanswered questions about this, and a need to deal with that, what Pat referred to as a feeling of resignation in the sector. And staff associations, as I said, may need to work with employers to make sure that members don't feel that negative effect as well. And you know, that we are reassuring our members, and we're keeping that talent within the organisations, within the sector. It is good to hear, from my point of view, that there doesn't seem to be a mass exodus out of the sector, out of the London market, and hopefully that's evident throughout the UK and continues. But much is still unclear, especially considering the lockdown situation, you know, what the impact of that is in comparison to Brexit. And let's not forget the potential employment bill as well, and how that's going to impact everything. You know, there's still work to be done on how our members are going to be impacted by that. And I mentioned just at the start of this, it goes further than just EU nationals come to this country, in UK, in the EU as well. So, you know, I think the impact, we need to make sure we're working with employers to make sure that any impact on nationals coming in, things like visa costs and NHS surcharge costs for people who are not national to this. Can we negotiate with employers that that is covered actually, so that we are still attracting talent from across the world, as it were? Mixture of events obviously makes it difficult to be absolutely sure in analysing figures and the reaction, and perhaps it'll be some time before we can actually look back with hindsight and put a finger on the impact of Brexit. And it's the wait and see what the impact of Brexit thing seems to have been going on since it was first even suggested, and yet we're still here saying the same thing. Let's wait and see what the impact is. So before we let you go, I just want to finish by sharing with you some of our upcoming events, and hopefully you see that. Is that? Hopefully we'll see you at the next couple. First of all, we've got a learning event for reps on the 13th of October, resolving disputes in the workplace. So this is going to be about representing in formal meetings, disciplinaries, grievances, and capability meetings. There was something about it in the last newsletter. If you are interested in, our email address will come up in a second. Just email in. There are still places available for that. We also sent round an invite to Morris Solicitor's employment law update on the 21st of October, 12 p.m. You're still able to register for that. I'll send out another reminder about that and the link so that you can register for that. And Morris have kindly agreed to do one specifically for the Alliance as well on the 4th of November, and we'll send around further details about that. As for these webinars, at the end of the year, we will have one on gender pay gap reporting. So as you may know, gender pay gap reporting was put back due to the pandemic, but by quarter 4 we will have the first round of gender pay gaps. So we'll be looking to do a webinar on that. And then in the first quarter of 2022, we'll also be looking to do a webinar on mediation in the workplace. And we've got a couple of speakers lined up to talk about that and how you can get the most out of that. So if you're interested in any further information about those, or you want to register for that learning event, then you can email info@allianceforfinance.org. Visit our website, allianceforfinance.org as well. This webinar has been recorded and will be on the website in due time. So if you want to share that with anyone in your organisation, then please feel free.
Nick, will the slides be available as well?
Well, I will ask the various. Well, I can ask you now, Shaun, Geoff. Are you able to make your slides available? Can I? I've already got them. Can I make them available?
Yeah, it's fine with me.
Yeah, with pleasure.
So I'll put those as well alongside in case. Obviously, you can watch the video and see them, but just in case you don't want to watch the whole thing, I'll put them alongside as a file. You can download that. So my thanks to everyone who's attended, and again, special thanks to Shaun, Geoff, and Pat. And I hope to see you all again at our next one. Bye-bye.
Thank you, everybody. Goodbye.
Thanks,
Thank
Nick.
you.
Bye all.